Good morning to everyone. So I just wanted to take this interesting topic, which is emotions, economics, and earnings. It's slightly quite interesting that at the end of the day, what we normally do is emotions play a lot of role. So behavioral finance actually has a lot of role to play. Uh, but underlying what normally prevails in the long run is actually more, economics and earnings, and that's why we thought we'll, delve on this topic. So I'll kind of start with, typically when we go into emotions, we normally think, particularly with regards to equity markets, it tends to be pretty volatile. We sometimes keep confusing and kind of interchangeably use between volatility and risk. Uh, we actually have a slightly differing view on this, and what we normally think is volatility is something that kind of keeps going up and down. It's actually a great opportunity to participate in great companies from time to time, and markets, provide you with that kind of an opportunity. Risk, on the other hand, is something which is, while it is also, up and down, it sometimes poses permanent risk to the capital that you deploy to that business. So that's something that we kind of, very, mildly differentiate between volatility and risk. And in that sense, that's something quite important. We actually like volatility. It's actually great for longer term wealth creation. Risk is something that we need to manage and ensure that there is no permanent risk to capital. So this is something on the emotion side that one has to look at it from time to time. And this is, since I came, there's been, I met a lot of people, and then they asked, markets are at a new high, what do you think of it? So obviously, when you actually, look at this, you might see that, since March, we've had a stellar run in the markets. But if you actually take a step back and look at things, you'll notice that from the previous peak, which is October of 2021, to say September of 2023, the large caps have done about 6%, the mid caps have gone up by about 24%, and small caps by about 22%. But typically for anything, price is equivalent to earnings into PE multiple. So when you kind of demarcate the two, what you'll ideally see is the data. What it suggests is during this time frame, earnings have actually gone up for across the board. Whether it be large caps, mid caps, or small caps, they've actually done quite well, and actually the PE has come down. So in that sense, it's been a slightly more healthier rally. But if you kind of look at the trailing PE multiples then and now, while that is corrected, and one might say that the headline valuations are still a little bit on the punchier side, especially for mid caps and small caps. I think one needs to look at it slightly more from a bottom-up perspective, and I'll come to it as to why that's important. And at a broader level, actually, bottom-up, still there is quite a lot of opportunities that we see. And this is something which is quite important, and behaviorally, this is, emotion-wise, this is something that one needs to, handle quite well for longer-term wealth creation. And this is the other important aspect. Typically, people ask, do we need to can we deploy lump sum? Can we wait now? Can we do STP? Can we do booster STPs? Or should we kind of hold off for some time? Now, that actually depends upon the risk appetite of the person and the investment horizon. But from an equity market perspective, once your asset allocation is done, and you've decided what is, in consultation with the distribution partner, what's the appropriate level of equity that one can have in the client's portfolio. What you need to understand is, in the long run, while there is a lot of volatility, in the long run, time in the market is a lot more important than timing the market. Yeah. So staying invested for the longer run is actually more important than just timing it. And even in the best of the bull markets, let's say 2005-6, we've had 5 drawdowns which have been more than 10%. So in that sense, you will have these kind of opportunities, and it's quite important to handle them well. And if you have that horizon in place, then staying invested is something which is quite important. Now, having looked at the emotions part of it, we can look at the economics part of it. And if you actually take a little bit of a step back and look at what's really happening, it's quite, interesting to see that the country is actually progressing quite well. Among the larger economies, we are still one of the, fastest growing economies in the world. We are currently at about $3.5 trillion, moving towards 5 and then eventually 10 by 2035. And that actually provides a lot of opportunities across the spectrum. Now, typically when I ask people what normally goes up when the GDP per capita of the country kind of moves up, the first answer typically is, people are conditioned to think that it's consumption. Because over the last 15 years, we've only had a consumption-based rally. But when you actually take a step back and look at economics, before people get their income, what happens is actually the government cuts taxes. So it's actually the government's income which goes up higher, and as income slabs move higher, the government's tax proportion actually increases. So it's actually a multitude of things which is interesting, and it has ramifications on the way you can participate in the wealth creation in the economy. And on that front, when you kind of looked at it, this is the aspect that I was trying to talk about. If you today kind of look at among the large economies, clearly on a high base, India is one of the few economies which is actually growing pretty well. And more importantly, after a very long time, we've had a resurgence in capital intensity in the economy. Now, this is very, very important because it has a higher multiplier impact on the economy. It creates a lot more jobs. It makes the consumption a lot more sustainable. And in that sense, it's something very, very important from a longer term perspective. And on this front, when you actually look at the last 10 years, what's really happened is government has basically taken the mantle of capacity creation within the country, particularly on the infrastructure side. And today, you've started to see private sector also now start to participate in that journey quite well. They have actually kind of caught up now. And this is a very interesting data point if you actually kind of look at it. If you kind of take the decade between 2003 and 2011, you will kind of see on the left-hand graph that operating cash flows for the listed space grew all the way from 0.4 trillion all the way up to 2.5 trillion. But capex also kind of moved in lockstep from 0.3 trillion to roughly about 3 trillion. And as a result, the debt to equity levels kind of stayed constant. But then you had a period of cleanup, and because the interest rates were kind of zero and stuff, we really focused a lot more on consumption. People kept consuming, and the markets didn't reward capex. And as a result, actually, when you kind of, the corporates also had to deliver their balance sheets. And that's the time when you kind of look at what's really happened. When you look at the next decade, you will see that the operating cash flows of the listed space has actually gone through the roof. It's almost tripled. It's moved from 3.4 trillion all the way up to 11.5 trillion at a time when the capex is actually only moved from 3.4 trillion to 5.5 trillion. Now, this has happened, and as a result of which you're actually seeing that debt to equity levels have actually been probably at one of the best levels that they've historically been. The corporate balance sheets are actually delivered, and they're looking ripe for spending. And why this is a little more important from a longer run is the fact that if you kind of take the last 15 years, what's important is that last 15 years we had US having US and a lot of developed markets having closer to 0% interest rates. But today we are closer to anywhere between, I think yesterday the print was closer to about 4.67 or so. But then we are hovering between that 4.5 to 5. Now, what has that done? That has actually taken up the cost of capital significantly higher. So today, for example, if you were to build a home in US, it will cost you 8.1%. Now, compare that with India. A prime customer in India can build a home loan today at 8.35. the largest private sector bank is actually giving out home loans at that rate. So in that sense, that's the sort of change that has actually happened. And this changes the landscape quite important, because what also happens is when interest rates were close to zero, you had a lot of private equity and venture capital funds who came and started disrupting all B2B businesses a lot more, because they were capital intensive. And when capital is available free of cost, then you can go and disrupt those businesses. So their profitability actually came under threat, and consumption companies were the ones which actually did quite well. But today, when the cost of capital is actually moved up, there's actually likely to be lesser competition out there. So that's one big change which has happened economically. When you look at the interest rates, that's something to take note of. Now, having looked at the economics part of it, how does that kind of translate into companies, and how do we build a portfolio of companies which can do well? This is a very interesting chart, and this is an inherent belief for us at the ICICI Prudential Alternates team, is that what we inherently believe is companies create wealth, not markets. And when you look at the data at the bottom, you will see that Nifty 500 return for the period. And when you actually take a 2010 to 15 sort of a time frame, it was one of the most toughest periods to make money in the markets when you kind of look at the returns. But just juxtapose that and look at what's happened to companies. How did the 500 companies do over that period? And here I would like you to look at, typically a 4 to 6 year window. That's why we've taken a 5-year window. And when you look at 5-year CAGR, what's really happened is the first bucket of companies is basically companies which have delivered more than 15% CAGR. Okay, when you look at that, that's something very, very, it's an eye-opener. The lowest number of companies over a 5-year CAGR that has generated more than 15% is 77 companies out of 500, which means roughly about 15% of the companies, irrespective of what has happened to the markets, have generated that kind of a return. And on the other side, if you look at that period alone, you have 256 companies which have generated that return in the better times, which means roughly 51% of the companies have generated that kind of a return. And 2017, that kind of was the peak. And at that point in time, that number was somewhere around 65, 66%. So that's a pretty high number. So in that sense, it's something very important that you stay bottom up and you, identify companies. That's a very, very, important aspect. This is what we focus on. We try to keep things simple. For stocks to move up, you need delta EPS and delta PE. We focus on that aspect. And when you actually dissect that particular data into companies and different buckets, what you'll essentially see is over this 15-year period, the companies that have done really, really well, they've had a PAT growth of closer to 17%, and they've had a median ROE, they've sustained it at a very high level of 18% for a period of 15 years. And if you happen to take them at a reasonable starting PE, which at that point in time was 19.5, then the market has re-rated them quite significantly. Now, when you come one level down, what really drives these returns? For instance, if you look at the next bucket of companies, their ROEs have basically trended down from 18.8 to 12.6, but then they still managed to grow earnings in double digits. And under that kind of a construct, the median PEs have actually held up quite reasonably. So what these two aspects effectively tell you, and then we come to the next two bucket of companies, is the fact that if you don't have your ROEs moving in the right direction, and if you don't have your earnings growth in the right direction, if you have this combination, it's actually disaster. It is recipe for wealth destruction. Okay, so this is the bunch of companies that we need to avoid. And the top two buckets are what we need to focus on. And what this data effectively tells you is, you need to focus on earnings growth and you need to focus on ROE improvement and getting them at a right risk reward. Not at any risk reward, at the right risk reward. So you need to triangulate these, and that is where you need to focus on, and that's what the data tells us. And we've kind of done that, and that's what we continue to focus on. Thankfully for us, when you kind of look at the markets, it's quite interesting that after a very, very long time, because, you've had you just need to look at this ROE chart in conjunction with what has happened with the interest rates in the developed world. If you actually look at the interest rates in the developed world, they started going into the zero territory sometime in 2009. And that is when the ROEs actually dropped, because all the big profit pools were with the companies which had higher capex intensity. And once that got disrupted, the entire ROE pool basically got disrupted, and you had companies which continued to burn capital and continued to chip away market share from companies which were making profits and reducing their profit margin as well. But as interest rates have moved up, they are now being forced to make money. And what has that done to the overall ROE of the listed space? It has started moving up, which effectively means we are getting into a value creation zone as far as the earnings aspect of an ROE aspect of the markets is concerned. And when you look at the longer term data in terms of price to book, long term average, we are broadly there as far as the large cap space is concerned. Mid cap and small cap, you can, while it's slightly higher, I think across the market cap spectrum, you can find companies bottom up that can give you this, triangulation. And that is what we focus on. Now, at this point in time, when you look at across sectors, where is the higher profit growth, where is the higher, and what are markets doing to it, you will essentially notice the fact that this is actually happening more in the B2B segment. Be it the corporate banks, be it the manufacturing companies, or be it the manufacturing allied companies. That is where the higher earnings growth is actually happening. When you kind of look at the data, say between March 2014 to March 2020, when Nifty earnings didn't do anything, to from March 2020 to March 2023, when Nifty earnings has actually improved quite substantially. But against that, when you kind of look at the market caps, not everything is done as well. They've still not had the re-rating that they need, whereas the consumption companies have still continued to do well, despite earnings growth not coming through. So this is where we need to focus on. We need to see where the risk reward is and kind of understand. And this is the other element when you actually look at the data. One is GFCF to GDP, which is fixed capital formation to GDP, which is on the left axis, which when you look at it today, it's moved from 31 to 34% of GDP, which effectively means there has almost been a 10 to 13% improvement in the capex intensity within the economy. But at the same time, when you look at what's really happened to the consumption aspect of it, it's kind of moved from, which is on the right hand chart, right axis, you will see that that's actually moved only from 57 to 58.5. While that's also improved, the aspect there is it's only moved up from 57 to 58.5. So to that extent, it's slightly, in terms of growth rates, it's slightly underperforming. And that's possibly one of the reasons that you're seeing that earnings in that particular bucket is actually, lower. And which is where, one needs to look at these things a lot more bottom up, which is what we at our end have done at, two of our flagship strategies. One is Contra, which is a flexi cap strategy, and Pipe, which is a small and mid cap strategy that we've kind of done. We focused a lot more on this triangulation, which is basically earnings growth, ROE improvement, and getting them at the right risk reward. And hence the higher tilt towards manufacturing and manufacturing allied businesses, and very little orientation towards the services or IT or consumer businesses versus what is there in the index. And to that extent, we actually stand quite away from the index. And that's kind of worked quite well, because in the long run, that's what works in terms of the markets typically reward with a lead and lag. It can lead sometimes, it can lag sometimes, but markets love earnings growth, market love ROE improvement, and if you get them at the right risk reward, then it really pays off. This is broadly a snapshot of our portfolio in terms of the key statistics. So you will kind of see that it has significantly higher profit growth and ROE improvement versus the index, and the trailing PEs are significantly lower. This is basically a culmination of we being able to identify, bottom up a lot more opportunities. a big result of, or big recipe to this is our largest research team, which covers nearly 500 companies. I don't think any other institution in the country covers so many companies. And that allows us to participate in each and every space where the opportunities are there. That's broadly what is there. I'll kind of stop here and yeah. Thanks.